Question 1. An open-end investment company is characterized by which of the following? It issues a fixed number of shares that trade in the secondary market. B. Its shares can be redeemed by the issuer only on a quarterly basis. C. It continuously issues and redeems shares based on the public offering price, POP. D. Its public offering price, POP, is determined by supply and demand on an exchange. Answer: C. It continuously issues and redeems shares based on the public offering price, POP. An open-end investment company, commonly known as a mutual fund, is defined by its ability to continuously issue new shares when a customer invests money and redeem shares when a customer liquidates a position. These funds are always open to new investors, meaning their capitalization is constantly changing. Shares are bought from the fund at the public offering price, POP, and sold back to the fund, redeemed, at the current net asset value, NAV. The continuous issuance and redemption at a price related to NAV is the core concept distinguishing an open-end fund from a closed-end fund. This structure provides investors with a high degree of liquidity, as they are guaranteed to be able to sell their shares back to the company. Question 2. The anti-money laundering (AML) compliance program of a broker-dealer must include which of the following provisions? A designated chief compliance officer who is registered with FINRA. B. Training of appropriate personnel and independent testing of the program. C. Annual filings with the Securities and Exchange Commission, SEC, detailing customer transactions. D. A public disclosure document outlining the firm's methods for detecting money laundering. Answer: B. Training of appropriate personnel and independent testing of the program. The Bank Secrecy Act, BSA, requires every financial institution including broker-dealers to establish and maintain an anti-money laundering (AML) compliance program. This program must, at a minimum, include training for relevant personnel to recognize suspicious activity and independent testing by an outside party or qualified in-house staff to ensure the program is effective. Firms must designate an AML compliance officer, but that officer is not necessarily required to be a registered representative or principal. This requirement is critical for detecting and preventing the use of the financial system for illegal activities, such as structuring transactions to avoid reporting thresholds. Question 3. What is the maximum sales charge that an open-end investment company may charge an investor, according to FINRA rules, if it does not offer any services such as breakpoints or rights of accumulation? 9%. B. 8.5%. C. 7.5%. D. 6.25%. Answer: B. 8.5%. The maximum sales charge permitted on a purchase of mutual fund shares, as outlined by FINRA rules for members, is 8.5% of the offering price. This maximum charge is permitted only if the fund offers 3 specific services to its customers: reinvestment of dividends at net asset value, NAV, breakpoints, reduced sales charges for larger purchases, and rights of accumulation, allowing an investor to qualify for a breakpoint by adding new purchases to prior holdings. If a fund does not offer one or more of these services, the maximum allowable sales charge is reduced to 7.25%. Therefore, 8.5% is the highest permitted load. Question 4. An application for a variable annuity contract must be approved by the principal of the selling firm within a specific time frame, as required by FINRA rules. What is this time frame? A. Promptly but no later than 7 business days after receipt. B. Promptly but no later than 10 business days after receipt. C. Within 30 calendar days of receipt. D. Before the application is submitted to the insurance company. Answer: A. Promptly but no later than 7 business days after receipt. FINRA rules require that a registered principal review and approve a completed variable annuity application promptly, and in no event later than 7 business days after the member firm receives the application. The principal's approval indicates that the firm has performed a suitability review of the customer's investment profile and that the transaction is appropriate for the client. This rule is designed to ensure that a timely and thorough suitability determination is made before the contract is issued. Prompt principal approval is a critical step in the sales process for all variable contracts. Question 5. Which type of investment company issues shares that trade on a stock exchange at a price determined by supply and demand, and may sell at a premium or discount to their net asset value, NAV? A. An open-end management company, mutual fund. B. A unit investment trust, UIT. C. A face amount certificate company. D. A closed-end management company. Answer D. A closed-end management company. A closed-end management company issues a fixed number of shares only once during an initial public offering, after which the shares begin trading in the secondary market on an exchange or over the counter. Because their shares are traded like stock, their price is determined by the forces of supply and demand, which is why the market price can be higher or lower than the fund's underlying net asset value, NAV. This is in contrast to an open-end fund, which continuously issues and redeems shares at a price directly tied to the NAV. Closed-end funds offer an initial capital raise, and the fund itself does not redeem shares. Question 6. A registered representative who has terminated employment with one member firm wishes to associate with another member firm. Which of the following forms must the new member firm file with FINRA? A. Form U4. B. Form U5. C. Form RE3. D. Form BD. Answer A. Form U4. The Uniform Application for Securities Industry Registration or Transfer, known as Form U4, is the correct filing the new member firm must submit to FINRA to register the individual. Form U4 is used to register an associated person with a self-regulatory organization, SRO, like FINRA, and to collect information about the individual's employment history, disciplinary actions, and residential address. The former employer would have filed a Form U5, Uniform Termination Notice, to terminate the individual's registration. The filing of a new Form U4 is the necessary step for establishing the new association. Question 7. The primary purpose of Subchapter M of the Internal Revenue Code is to A. Mandate the maximum sales charge that an investment company can impose on investors. B. Limit the amount of debt that a mutual fund can carry on its balance sheet. C. Allow an investment company to avoid taxation on the earnings it distributes to shareholders. D. Define the minimum capital required for an investment company to operate. Answer C. Allow an investment company to avoid taxation on the earnings it distributes to shareholders. Subchapter M, also known as the conduit theory, allows a mutual fund to act as a pass-through vehicle for tax purposes, meaning the fund itself avoids paying taxes on the net investment income it distributes to its shareholders. To qualify as a regulated investment company, RIC, under Subchapter M, the fund must distribute at least 90% of its net investment income to shareholders. By meeting this distribution requirement, the fund is only taxed on the income it retains, and the distributed income is taxed only once at the shareholder level. This avoids double taxation, making mutual funds a tax-efficient structure for investment. Question 8. In a mutual fund prospectus, the disclosure of a 12b-1 fee indicates that the fund may use its assets to pay for which of the following? A. Investment advisory and portfolio management fees. B. Custodian bank and transfer agent administrative services. C. Distribution costs such as marketing and sales literature. D. Capital gains taxes resulting from the sale of portfolio securities. Answer C. Distribution costs such as marketing and sales literature. A 12b-1 fee is a charge deducted from a mutual fund's assets to cover sales-related and marketing expenses, which are considered distribution costs. These expenses can include paying commissions to registered representatives, advertising the fund, and printing sales literature. The fee is calculated as a percentage of the fund's average annual net assets and is named for the SEC rule that permits this practice. This fee is a component of the fund's operating expenses and is always disclosed in the prospectus. Question 9. An investment in a variable annuity is considered a long-term investment that is typically suitable for which of the following purposes? A. Short-term savings goals such as a down payment on a house. B. Immediate income needs for individuals in retirement. C. Retirement planning and accumulation of assets over many years. D. A tax loss harvesting strategy in a non-qualified account. Answer C. Retirement planning and accumulation of assets over many years. Variable annuities are generally most suitable for long-term objectives, such as saving for retirement, because of their purpose and structure, which includes tax-deferred growth and potential surrender charges for early withdrawal. The variable nature means the account value is tied to the performance of the separate account's underlying investments, introducing market risk over the accumulation period. Due to the high potential surrender charges, variable annuities are explicitly unsuitable for short-term savings goals or income needs, as clients may incur a penalty for accessing the funds early. Suitability requires that a registered representative ensure the client understands the product's long-term nature and associated costs. Question 10. A transfer on death (TOD) designation on a customer's brokerage account means that upon the death of the account owner, the assets are a. held in probate until a court-appointed executor distributes them. b. distributed to the named beneficiary according to the account agreement. c. subject to the specific distribution instructions outlined in the owner's will. d. frozen and subject to taxation at the highest marginal rate. Answer: B. Distributed to the named beneficiary according to the account agreement. A transfer on death (TOD) designation is a non-probate registration that allows the account owner to specify a beneficiary who will directly receive the assets upon the owner's death. Since the assets bypass the time-consuming and costly probate process, the transfer is generally quicker and less expensive than a distribution under a will. The TOD provision is specified in the account agreement and is an effective tool for simplifying the transfer of assets at death. This designation streamlines the process of transferring assets and maintains client privacy. Question 11. What is the tax treatment for an investor who makes a non-qualified withdrawal from a variable annuity during the accumulation period? A. The withdrawal is fully taxed as ordinary income. B. The withdrawal is first considered a return of cost basis non-taxable, followed by earnings, taxable as ordinary income. C. The withdrawal is first considered earnings, taxable as ordinary income, due to the last-in, first-out (LIFO) method followed by non-taxable cost basis. D. The entire withdrawal is subject to a 10% early withdrawal penalty, but not ordinary income tax. Answer: C. The withdrawal is first considered earnings, taxable as ordinary income, due to the last-in, first-out (LIFO) method followed by non-taxable cost basis. When an investor takes a non-qualified withdrawal from a variable annuity during the accumulation phase, the Internal Revenue Service (IRS) applies the last-in, first-out (LIFO) accounting method. Under the LIFO rule, all earnings are considered to be withdrawn first and are subject to taxation as ordinary income. After all the earnings are withdrawn, the remaining principal cost basis can be withdrawn tax-free. If the owner is under age 59, 1, 2, 59, 2, 1. The taxable earnings portion may also be subject to a 10% early withdrawal penalty. Question 12. FINRA rules regarding gifts and gratuities state that a registered representative may give a gift to a person other than an employee of their own firm, provided the gift does not exceed a value of $50 per person per year. B. $100 per person per year. C. $250 per person per year. D. $500 per person per year. Answer B. $100 per person per year. To prevent any improper business influence, FINRA rules restrict the value of gifts that a registered person can give to anyone with whom the member firm does business. The limit is $100 per individual per year, which applies to gifts like tickets to an event or a cash equivalent. However, this limit does not apply to reasonable business entertainment, such as an occasional meal or sporting event, if the registered representative is also in attendance. The $100 rule is a key concept designed to ensure fair business practices. Question 13. Which statement accurately describes a key characteristic of Class B mutual fund shares? A. They charge a front-end sales load, but the fee is waived for very large purchases. B. They do not charge a sales load, but they impose a high 12b1 fee. C. They charge a contingent deferred sales charge (CDSC) that declines to zero over time, often converting to Class A shares. D. They have a low 12b1 fee and are primarily sold to institutional investors. Answer: C. They charge a contingent deferred sales charge (CDSC) that declines to zero over time, often converting to Class A shares. Class B shares of a mutual fund are distinguished by their back-end load structure, which is a contingent deferred sales charge (CDSC) that an investor pays when redeeming shares. This CDSC declines over a period of several years until it reaches zero. A significant feature of Class B shares is that, after the surrender period is over, they often automatically convert to Class A shares, which typically have lower 12b-1 fees. Class B shares are designed for investors who have a moderate amount of money to invest but cannot meet the breakpoint for Class A shares. Question 14. Which of the following describes the status of the separate account in a variable annuity? A. It is part of the insurance company's general assets, which are backed by fixed income securities. B. It is a regulated investment company, RIC, under Subchapter M of the Internal Revenue Code. C. It is a pool of assets, generally registered as a unit investment trust or open-end management company, whose investment returns are passed directly to contract owners. D. It is an asset reserve established to guarantee the fixed payments of a variable annuity during the annuitization phase. Answer: C. It is a pool of assets, generally registered as a unit investment trust or open-end management company, whose investment returns are passed directly to contract owners. The separate account of a variable annuity is the pool of investments that determines the contract's cash value and is kept legally segregated from the insurance company's general assets. This account is registered as an investment company under the Investment Company Act of 1940, typically structured as either a unit investment trust (UIT) or an open-end management company. The owner's investment in the separate account is measured in accumulation units, and the investment performance directly dictates the growth or loss in the contract value. Because the client bears the investment risk, the variable annuity contract is regulated as a security. Question 15. The Investment Company Act of 1940 requires that a majority of the board of directors of a registered investment company must be A. Senior officers of the fund's investment advisor. B. Affiliated persons who hold shares of the fund. C. Interested persons such as the fund's accountants or lawyers. D. Independent persons, meaning they are not affiliated with the fund's underwriter or investment advisor. Answer: D. Independent persons, meaning they are not affiliated with the fund's underwriter or investment advisor. To ensure that management decisions are made in the best interest of the shareholders, the Investment Company Act of 1940 mandates that a minimum of 40% of an investment company's board of directors must be independent. This means they are not affiliated with the fund's investment advisor or underwriter. While a majority of independent directors is not always required, most funds target this for legal and ethical purposes. The goal of this provision is to prevent conflicts of interest and maintain oversight on how the fund is managed. Question 16. A registered representative is prohibited from borrowing money from a customer unless which of the following conditions is met? A. The customer is an immediate family member. B. The representative has given the customer a written disclosure outlining the terms of the loan. C. The loan is a short-term, non-interest-bearing arrangement. D. The representative is an independent contractor and not a direct employee of the firm. Answer: A. The customer is an immediate family member. FINRA Rule 3240 generally prohibits a registered representative from borrowing money from or lending money to a customer. However, there are 5 exceptions to this rule, one of which is if the customer is an immediate family member of the registered representative. Other exceptions include lending institutions and situations where the firm has written procedures allowing the arrangement under certain conditions. This rule is in place to prevent potential conflicts of interest and to protect customers from undue influence. Question 17. The primary purpose of the Securities Act of 1933 is to A. Regulate the trading of securities in the secondary market. B. Require full and fair disclosure for the offering of new securities. C. Define prohibited fraudulent practices in the sale of securities. D. Establish a uniform standard of fiduciary duty for investment advisors. Answer: B. Require full and fair disclosure for the offering of new securities. The Securities Act of 1933, often referred to as the Paper Act, is the federal legislation that primarily regulates the primary market, which is the initial issuance of securities. Its central goal is to require issuers to provide full and fair disclosure of all material information about a new security in a registration statement and prospectus. The Act does not guarantee the investment's merit or value, but rather ensures that investors have sufficient information to make an informed decision. This focus on disclosure during the offering process is the key concept of the Act. Question 18. A municipal fund security such as a 529 college savings plan is sold to an investor using an official statement, which is the disclosure document. Who prepares and is responsible for the accuracy of the official statement? A. The Municipal Securities Rulemaking Board, MSRB. B. The issuer of the municipal fund security. C. The managing underwriter for the offering. D. The registered representative selling the plan. Answer: B. The issuer of the municipal fund security. The issuer of the municipal fund security, such as the state agency sponsoring the 529 college savings plan, is responsible for the preparation and accuracy of the official statement, which is the disclosure document. Similar to a prospectus for other securities, the official statement provides all material information about the plan, the securities being offered, and the financial condition of the issuer. While the underwriter assists in distribution, the liability for the information's accuracy rests with the issuer. The MSRB regulates the sales and conduct of the firms involved in selling these securities, but not the document itself. Question 19. A registered representative recommends that a customer purchase Class A shares of a mutual fund with a high sales charge, even though the customer's total investment is substantial enough to qualify for a breakpoint that would significantly reduce the sales charge. This prohibited practice is known as a breakpoint sale. B. Painting the tape. C. Front running. D. Selling away. Answer: A. Breakpoint sale. A breakpoint sale is the prohibited practice of selling mutual fund shares to a customer in an amount just below the dollar threshold required to qualify for a reduced sales charge, which is known as a breakpoint. This practice is a violation because the registered representative is failing to offer the customer a lower sales charge that they are entitled to, thereby maximizing the representative's commission at the customer's expense. The clue here is the customer's substantial investment not receiving the appropriate lower rate. Representatives have an obligation to ensure customers receive the best available sales charge. Question 20. The ongoing education requirement for registered representatives consists of two components: the regulatory element and the firm element. The regulatory element must be completed by a registered representative within how many days of their second registration anniversary and every 3 years thereafter? 30 days. B. 60 days. C. 90 days. D. 120 days. Answer: D. 120 days. The regulatory element of the continuing education requirement mandates that all registered persons complete a computer-based training session within 120 days of the second anniversary of their initial registration date. After this initial cycle, the training must be completed every 3 years thereafter. The purpose of this element is to ensure that registered representatives stay current on regulatory, compliance, and ethical standards, and it focuses on general industry topics. Firms are responsible for tracking and ensuring their representatives complete this requirement. Question 21. Which of the following is a primary consideration when a registered representative determines the suitability of a variable life insurance policy for a customer? A. The customer's need for a high cash surrender value in the first 2 years. B. The customer's current level of disposable income and existing life insurance coverage. C. The customer's desire to invest in a tax-deductible product. D. The customer's preference for a fixed, guaranteed rate of return on the cash value. Answer: B. The customer's current level of disposable income and existing life insurance coverage. Suitability for a variable life insurance policy is determined by analyzing several factors, but the primary considerations include the customer's existing insurance needs and their financial ability to absorb the risk and cost of a long-term, complex product. Specifically, the customer must have an insurance need, and their current disposable income must be sufficient to cover the premium payments, which are not fixed and may increase. Variable life is not suitable if the client has an immediate need for cash or wants a guaranteed return, as the cash value fluctuates based on the separate account's performance. Question 22. In the accumulation phase of a variable annuity, the value of the owner's investment is expressed in A. Annuity units. B. Investment units. C. Accumulation units. D. Shares of beneficial interest. Answer: C. Accumulation units. During the accumulation phase, while the investor is contributing money, their participation in the variable annuities separate account is measured by accumulation units. The number of accumulation units owned remains the same unless new money is invested or a withdrawal is made, but the value of each unit fluctuates daily based on the performance of the underlying investments. When the owner decides to begin receiving payments, annuitization, the accumulation units are converted into a fixed number of annuity units, which is the measure used during the payout phase. Question 23. A prospectus must be delivered to a customer purchasing a new issue of an open-end investment company, mutual fund, no later than the confirmation of the sale. B. The settlement date of the transaction. C. The time of the solicitation. D. Before or during the solicitation. Answer: D. Before or during the solicitation. According to the Securities Act of 1933, a full prospectus or a summary prospectus must be provided to a prospective mutual fund investor at or before the time of solicitation. This ensures that the customer has the opportunity to review the fund's investment objectives, risks, costs, and performance history before making an investment decision. This key disclosure requirement is central to the concept of full and fair disclosure in the primary market. The delivery of a prospectus is the responsibility of the selling broker-dealer. Question 24. A registered representative must clearly communicate that the variable death benefit of a variable life insurance policy is primarily determined by the performance of the A. Insurance company's general account. B. Cash value in the separate account. C. Policy's guaranteed minimum rate. D. Policy's loan account balance. Answer: B. Cash value in the separate account. The variable death benefit of a variable life insurance policy is directly linked to the performance of the assets held in the separate account. As the cash value in the separate account increases due to positive investment performance, the death benefit may also increase above the guaranteed minimum. Conversely, poor performance may reduce the death benefit, although it will never fall below a contractually guaranteed minimum. The separate account's unit values fluctuate with the market, defining the variable nature of both the cash value and the death benefit. Question 25. An investor who purchases an open-end investment company is buying shares from the A. Previous owner in the secondary market. B. Investment advisor on the Nasdaq stock market. C. Investment company itself. D. Underwriter at a negotiated price. Answer: C. Investment company itself. An open-end investment company or mutual fund is required to continuously stand ready to issue new shares to investors and redeem shares back from investors. Therefore, when an investor purchases a share, they are buying it directly from the fund itself, which is what makes these shares new issues. The investment company sells the share at the public offering price (POP) and buys it back at the net asset value (NAV). This characteristic is the reason open-end funds have an ever-changing number of outstanding shares. Question 26. Which of the following is true regarding a statutory disqualification from FINRA membership? A. It applies only to individuals who have been convicted of a felony. B. It requires an individual to retake and pass the Securities Industry Essentials (SIE) exam. C. It automatically prevents a person from associating with a member firm in any capacity. D. It can result from a conviction for a securities-related misdemeanor within the last 10 years. Answer: D. It can result from a conviction for a securities-related misdemeanor within the last 10 years. A statutory disqualification is a serious regulatory event that generally prohibits an individual from becoming or remaining registered in the securities industry. This includes but is not limited to a conviction for any felony or a securities-related misdemeanor within the last 10 years. This type of disqualification is designed to protect the public from individuals who have demonstrated an inability to comply with securities laws and regulations. If disqualified, the individual must apply to FINRA for special permission to associate with a member firm. Question 27. When opening a new options account for a customer, the registered representative must ensure the customer returns the signed options account agreement within how many days of the account's approval? A. 5 days. B. 10 days. C. 15 days. D. 30 days. Answer: C. 15 days. The registered representative must ensure that the customer signs and returns the options account agreement to the firm within 15 calendar days after the account is approved by a registered options principal, ROP. This agreement confirms that the customer has read and understood the options disclosure document and the risks associated with options trading. If the customer fails to return the signed agreement within this 15-day window, the firm can only accept closing transactions for that account until the agreement is received. Question 28. Under Regulation Best Interest, Reg BI, when a registered representative recommends a variable annuity to a retail customer, the required disclosure must be provided. A. Annually prior to the assessment of any maintenance fees. B. At the time of the recommendation in writing. C. Only if the customer requests it in writing. D. At the point of sale verbally and followed by written confirmation. Answer: B. At the time of the recommendation in writing. Regulation Best Interest, Reg BI, requires a broker-dealer and its registered representatives to provide certain disclosures to a retail customer at or before the time a recommendation is made. This required disclosure must be in writing and clearly outline the capacity in which the firm is acting, the fees and costs associated with the transaction, and any material conflicts of interest. The goal of Reg BI is to require firms to act in the retail customer's best interest when making a recommendation. Question 29. Which investment characteristic most clearly distinguishes a unit investment trust (UIT) from an open-end management company? A. A UIT is not required to register under the Investment Company Act of 1940. B. A UIT has an actively managed portfolio that changes based on market conditions. C. A UIT's portfolio is generally fixed and supervised but not actively managed. D. A UIT is prohibited from holding municipal bonds in its portfolio. Answer: C. A UIT's portfolio is generally fixed and supervised but not actively managed. A unit investment trust (UIT) is defined by its fixed portfolio of securities, which is established when the trust is created and generally does not change. Once the securities are deposited, they are supervised by a trustee but are not actively traded, meaning there is no investment advisor making continuous buy and sell decisions. This is in sharp contrast to an open-end management company, mutual fund, which is actively managed to achieve a stated investment objective. The fixed portfolio structure is a key distinguishing feature of the UIT. Question 30. A registered representative is suspected of having excessively traded a customer's account for the primary purpose of generating commissions. This prohibited practice is known as selling away. B. Free riding. C. Churning. D. Front running. Answer: C. Churning. Churning is the prohibited and unethical practice of engaging in excessive trading in a customer's account primarily to generate commissions for the registered representative, with little regard for the customer's investment objectives. The core concept is that the trading activity is quantitatively and qualitatively unsuitable for the client. The key clue is the phrase, excessively traded, for the primary purpose of generating commissions. Churning is a serious violation of FINRA rules because it violates the duty to act in the customer's best interest. Question 31. The primary purpose of a customer's investment objective and risk tolerance information, gathered by a registered representative, is to A. Determine the customer's eligibility for certain tax-advantaged accounts. B. Complete the broker-dealer's anti-money laundering (AML) compliance documentation. C. Fulfill the representative's obligation to ensure all investment recommendations are suitable. D. Establish the appropriate net worth for the account to be classified as an institutional investor. Answer: C. Fulfill the representative's obligation to ensure all investment recommendations are suitable. A registered representative is legally and ethically obligated to make suitable recommendations to their customers, a core requirement of FINRA rules and Regulation Best Interest, Reg BI. The customer's investment objective, risk tolerance, and financial situation are the foundational components used to determine which investments are appropriate for them. The primary purpose of gathering this information is to have a reasonable basis for believing that the recommendation is in the customer's best interest. Question 32. In the context of a non-qualified variable annuity, the cost basis is defined as the A. Current cash surrender value of the contract. B. Total amount of premiums, money, the investor paid into the contract. C. Market value of the contract's accumulation units at the time of annuitization. D. Sum of all investment earnings and dividends reinvested. Answer B. Total amount of premiums, money, the investor paid into the contract. The cost basis for a non-qualified variable annuity represents the total amount of money or premiums that the investor paid into the contract. Since these payments were made with after-tax dollars, the cost basis is the non-taxable portion of any withdrawal or payout. This is distinguished from the earnings or growth in the contract, which is the taxable component. Understanding the cost basis is essential for determining the tax consequences of a withdrawal. Question 33. A registered representative must provide a new account form to the customer for verification within how many days after the account is opened? A. 15 days. B. 30 days. C. 60 days. D. 90 days. Answer B. 30 days. FINRA rules require that a member firm send a copy of the new account form or a written account record to the customer within 30 days of opening the account. The purpose is for the customer to review the information, confirm its accuracy, and notify the firm of any discrepancies. Furthermore, the firm must send an updated account record to the customer at least once every 36 months thereafter. This process ensures the suitability information is current and accurate. Question 34. What type of power of attorney, POA, remains in effect even if the grantor becomes mentally incapacitated? A. General power of attorney. B. Limited power of attorney. C. Non-durable power of attorney. D. Durable power of attorney. Answer D. Durable power of attorney. A durable power of attorney, DPOA, is the specific legal document that allows the appointed agent to continue managing the grantor's financial affairs even if the grantor becomes mentally incompetent. Without the durable designation, a standard power of attorney, general or limited, immediately terminates upon the grantor's incapacitation. The durable feature is essential for ensuring that someone can still act on behalf of the customer for necessary financial decisions if they lose the capacity to do so themselves. Question 35. A mutual fund that qualifies as a diversified investment company under the Investment Company Act of 1940 must meet which of the following requirements? A. At least 75% of its total assets must be invested in securities, and no more than 5% of its total assets can be invested in the securities of any one issuer. B. No more than 10% of its outstanding voting shares can be held by any one person. C. At least 90% of its gross investment income must be distributed to shareholders each year. D. No more than 25% of its assets may be invested in the securities of companies within one industry. Answer A. At least 75% of its total assets must be invested in securities, and no more than 5% of its total assets can be invested in the securities of any one issuer. To be classified as a diversified investment company under the Investment Company Act of 1940, the fund must meet the May 10, 75 rule. This rule means at least 75% of the fund's total assets must be invested in securities. Furthermore, of that 75%, no more than 5% of the total assets can be in the securities of any one issuer, and the fund cannot own more than 10% of the voting stock of any one issuer. This rule is designed to ensure the fund is broadly diversified, reducing the concentration risk inherent in holding too much of a single company's stock.